are focusing on the specific concern that we have for the baby boomer generation. Those are the pre-retirees of our nation. The lessons we can learn from the financial distress that the baby boomers are currently experiencing is a key example of how this research can clearly and factually show that if we don't take savings seriously from an early state, we have some worries and concerns for the broad population. These baby boomer findings are equally alarming when they are related back to the current financial mindsets of our youth, who make over 50% of our adult population, as most of you know. In this research, we found that 43% of the youth, and those are economically active youth between the ages of 18 and 30, do not have any formal financial retirement plans. 43% of them. And 26% of them believe that saving for the future is not a priority right now. So this is a major concern when one thinks about the future that the youth has to play in this economy going forward. And although we know that South Africa has a dismal savings rate and that our people are deeply swamped in debt, there are some positive signs here and there that are pointing in the right direction. For example, the government, for one, is committed to improving the savings and environment in the country. Firstly, with the Social Security and Retirement Reform Initiative. Secondly, the National Financial Education Framework. Thirdly, the protection of consumer rights under the new Consumer Protection Act, as well as a substantial increase in allowable tax deductions and tax concessions that we have now, which have a particular focus of encouraging private savings both in the short and long term. The financial planning industry has also made great strides in professionalizing the industry. And the FSB, with their financial literacy focus, are all clear demonstrations of the positive action being taken in terms of developing the important building blocks of a sustainable economy. Understanding the South African market is one thing, but Old Mutual is more than South Africa. We are an emerging markets player. And in being an emerging markets player, we need to make sure that we understand all our markets so that we can provide relevant and beneficial solutions to all our customers, regardless of geography. So today, we are also proud to share with you some of the Savings and Investment Monitor research results that we've also done in the other African countries where we have presence, and those are Namibia, Zimbabwe, Kenya, and Nigeria. We at Old Mutual are a responsible business and a good corporate citizen. And we have an important responsibility to South Africa to do what we can to empower our customers and all South Africans to make sure that they have better financial futures. Our Old Mutual Savings and Investment Monitor is about empowering people with knowledge. So the theme that we have running through this year's output and results is know better so that you can do better. And as Benjamin Franklin said, an investment in knowledge always pays the best interest. So simply put, what we all aim to do here today and for the future is to encourage all South Africans to act now and do great things, as our brand payoff line usually says. Do great things for your financial future. We encourage people to get expert financial advice, to start planning as soon as possible, and seek to understand and be educated about financial options and choices. So at this point, I don't want to lift the lid on the research. That's not my job to do. We've got a very competent team in Lynette Nicholson, who will be followed by Rian Leroux, to unpack not only the results, but to start talking about the economy as well. So at this point in time, I'm going to hand over to Lynette, who's going to get to the details of the research. Lynette, over to you.
Thanks, Mokahedi. We weight the data that we gather back to the South African working metro population according to AMS. So most of the figures that you see are in accordance with that. What we do have are different focus areas, which Mokahedi's mentioned, and then we take a deeper look into some specific areas, such as baby boomers, or the high income market is another one that we're going to be looking at today, which is a new angle. Right, that's just a little bit of history, where we started, where we are, and some of the focus areas we've had along the way. So today, as we've said, baby boomers and the high income market, plus a little bit, it's quite a big load today, I need to warn you, quite a little bit on the other African savings and investment monitors, and for those that are interested, although we won't go into too much detail, a little bit more on Stokvels as well. So very important, our definition and the definition that we carry through in the survey is what is savings, and it is putting money away into savings accounts, policies, and investments. And that is any type of savings accounts, policies, and investments. It includes pension provident funds, it includes RAs, it includes endowment policies, education policies, and it even includes medical aid and short-term insurance, which are classified as precautionary savings. And that's important to remember when we go through. And on the other hand, it's also holding back holding back money to pay debt faster. So it does not include a normal home loan installment, which is debt, but if you are paying it off faster, that would also, or putting more money into it, it would classify as a form of savings. Right, so with that behind us, we conducted this research just going into the second quarter of this year. So what was the backdrop to that time? And these figures, they're not always the most up-to-date figures because it's based on the first quarter of this year, where we saw that our consumer confidence was rather low. It wasn't at its all-time low, but pretty close to that. Petrol price was the highest in South African history on the 5th of March this year. The CPI was just over 6%, so the upper threshold, and it's gone higher than that following this research. And then, of course, our GDP figures were not that great at this time. And of course, another one added onto this, which we haven't included, is that the unemployment rate also did a little bit of an uptick from the fourth quarter of last year to the first quarter. It was 24.1, it's now it was in the first quarter 25.2, so 1.1%, which is not insignificant. Right, we ask our audience or our respondents their confidence that they feel in the South African economy. So the question is worded, how much I feel confident in the South African economy, and they can say how much they agree or disagree. This is the percentage of people that say they agree, that they feel confident in the economy. And you can see that if you did a straight line down over time, that would be on a declining trend. So 52% saying, I feel confident in the South African economy. Very interesting, remembering this figure when we go into a little bit later in terms of some of the other African countries where we ask the same question. Right, so let's get into the main set of results before we go into the focus areas. There are 4 metrics here. The top left hand, the confidence in making financial decisions. So how confident are you in making financial decisions? It's a score out of 10, where 1 is not at all confident and 10 is extremely confident. What you see here is a mean score out of 10. Not always great to look at mean scores, as we know, because sometimes the difference in the the movement cancels each other out and you get a similar score. But nevertheless, for this presentation, we're going to be looking at the mean score. So a little bit of a downward movement there from a 7.2 to a 6.9. And yes, absolutely, there are differences in different income levels. This is the overall. The second one is satisfaction with current financial situation, also out of 10. You'll see that it's remained constant at 6.5. However, having said that, this is one of the places where the mean score doesn't do justice to the metric, is what we do see is when we look at the different income levels, you see that the lower income levels have gone down quite significantly. The upper income levels have gone up, and it kind of cancels each other out. Not cancels each other, that's not the right word, but to get a mean score of 6.5. So what we start seeing here is really a deterioration in the lower end, the lower income levels, more so than we've seen before. And this comes out in a number of the results going forward. Expectation of your financial situation improving in the next 6 months. So last year this time, 1 in 2 felt that their financial situation was going to improve, and that's also declined somewhat. Compared to a year ago, is your financial situation better, the same, or worse than? This metric talks around better than it was a year ago. Once again, you can see a downward movement there. So the story around this slide, and we see it coming out again and again, is a little bit more not so confident, not so happy with finances, quite a bit more financial stress in people's lives. Saving less than a year ago. It's a bit of a tricky slide to present. We ask people once they've been through all the savings vehicles and we've chatted to them about saving and what we mean about saving, and we say, now thinking about all of this, are you saving more, less, the same as you were a year ago? This diagram just shows the less than, right? I'm saving less than I was a year ago. You'll see 2009 was kind of a big 52% saying they're saving less than a year ago. It was really coming out of the 2008 financial, whatever we want to say, tsunami, some people call it, financial turmoil in the market. But once again, if you had to draw a line or a trend from 2010, you'd see that, you'd notice that more people, marginally more people, are saving less than they were before. And having said that, it's not coming off a good platform anyway, because we weren't saving well before, so saving less than we were before is always like a bit of a double whammy. This slide is a new question we've introduced. Just another question to kind of gauge where people are and where households are. And we've called it the Financial Household Comfort Indicator. And this would obviously add up to 100%. And we ask households, where are you? Kind of ranging from finding it very difficult to cope financially right up to living comfortably. So living comfortably, 9%. Only. Of course, that does change again once you look at the different income levels. Our upper income level, I think I pulled the figures yesterday, the upper income level is around 29% there, and the lower income level is around 1% saying living comfortably. And so the results stack up respectively in terms of income levels. But just to give you a good indication, and we'll track this one going forward into following years when we do the Savings and Investment Monitor. We haven't really presented this set of results before. Our survey contains a lot of results. So I urge you just at this stage, if I can say, if there's a certain thing that we haven't covered today, and you think, oh, I wonder if you've got results on that, please ask, because we may have. This is, we sit with the families, and it's quite a difficult one, because you can imagine to try and get this type of information and calculate it. Can you look at your income, your gross income, and tell us kind of what is the percentage you're spending on consumption, debt, insurance and medical aid, which is that precautionary savings, which we've separated out from savings. And really the picture there, I don't need to tell you that, but you can see. So consumption, 65%, it's gone up quite a bit since last time and since previous years. Debt servicing, this is just not kind of what my debt's worth, this is paying servicing debt, 15%, insurance and medical aid at 6%, and then the proportion that people are saving, or the amount that people in the proportion. So this is pension, provident, all those vehicles that I spoke about at the beginning has done a kind of significant drop to 14. Once again, when we look at the high income market and we do a focus on that, you'll see quite a different picture here as well. So all the signs, all these slides are telling the same story. So where are we? 2011, those of us who saw the presentation in 2011 would know that we said we were really panicked. We were kind of coming out of 2008, 2009. A lot of panic about household financial situations. 2012, we found were becoming a little bit more circumspect, looking at their finances, trying to find ways to cut down. That carried on through to 2013, a lot to do with cutting down on expenses, and we did quite a bit of in-depth research about how people were doing that. And then now, things haven't got better. In fact, they've declined somewhat. It's very cautious and concerned around household finances. Right, what are people saving for? This is not what vehicles they're saving in. This is just when we say to them, so what are you saving for? We've presented the slide slightly differently this year, and I hope you like it because it's quite a nice story. The winners, what does that mean? It means year on year, more people said that they were saving for funeral expenses than before. Okay, so that's what we called a winner, where the incidence of saving had gone up. That was on an overall level. End of year Christmas. This was an interesting one for us. We've only tracked this one for 2 years now, and last year this time, overall you had 6% saying they were saving for end of the year Christmas. This year, it's 15%. Saying I'm saving for end of the year Christmas. I'm not sure if that's because people had a bad Christmas last year, maybe they didn't save enough. I'm not too sure about that, but certainly people, and I suppose you can look at it in a positive sense. So maybe people are planning better, saving more for the end of the year. Otherwise, they're just planning to do more at the end of the year. Retirement old age, there's two sides to this. You can see on the winner side, you can see this nicely, is in the 40K per month household income category, we saw more putting into saving for retirement or old age, which is a good thing. However, going over to the other side, and we're going to go straight to the bottom, so I can do a comparison, is your baby boomer generation, and let's just make that definition clear, is born 1964 and prior to 1964. However, our population that we survey is a working population, so it would be people 50 years to 64. Okay, and that's where we would cut off. So that's our baby boomer. Baby boomers putting less, and as Mokahedi said up front, rather a worrying trend into retirement old age. Not putting less in, but fewer people saving. This is an incidence of saving. Saving for cars or vehicles has declined. Debt reduction. So yeah, we do get people saying, I'm saving to pay off debt. Okay, so that's also gone down. And property is a loser here, both in terms of home improvements, so saving to do renovations or home improvements, and saving for deposits for a new home. Children's education, I'm afraid to say, has also seen a decline, and we saw the first sign of this last year, where we also started seeing that little blip in terms of children's education, and particularly in the Generation X and the baby boomer generations, which makes sense because those are the generations that have children to a large extent than the Y generation. And then holidays. Holidays have also declined, although end of the year and Christmas, so read those together. However, once again, and I'll preempt, not totally, but when we get to the upper income, we will see the prominence or the importance that holidays play in their lives. Right, so that was just what are you saving for? We look at what vehicles. So, do you have cashed bank savings or cash non-bank? So let's go through these. The slide builds. The slide in your packs is quite a busy slide, so if you want us to just clarify anything for you afterwards, please ask. So let's look at the first one. That's cashed That's banked cash savings, money market accounts, 3 months fixed deposits, other cash savings. Draw a line through that. There's a declining trend. Right, cash savings not banked. It's really an informal saving. We classify that under informal, money under the mattress, money in the cookie jar, and not anything major there, kind of very stable, kind of just below 10%, or just on 10%. Funeral policies, we saw that was a winner, remember in the previous slide. So more people putting money into funeral policies. And it's already right up there between, well, now it's over 70%. So it's that and informal savings as a whole are the two greatest kind of vehicles, or the two largest vehicles where people are putting money. That's life assurance, death and disability. A little bit of a, that's why it's lovely to have all this data for so many years, that you can start putting trend lines into the data, but really just around the below, between 35 and 40%. Life assurance, death and disability. Pension provident funds, which is quite a nice picture. If one put a line through there, you'd see slightly more than previous years. I'm not sure if that's maybe a reaction to some of the reforms that are coming in, people preempting that that's going to happen. But still, having said that, on the positive side, we need to understand and remember that this is a working metropolitan population. All right. And less than 60% are putting into a pension or provident fund. So that's the other side of the coin. Education policies, we saw that little downward kick last year, and then it's kind of evened up again. But if one did a line through that, again, you would see a downward trend. RAs, very, very, it's around 24%, very consistent. And these are informal savings. So informal savings here is stokvels, burial societies, and grocery schemes, all put together. Okay, and that's you can see a little bit of a downward, and we're going to downward trend there, and we're going to talk about that a bit going forward. So, what you don't see on here is unit trusts, and I know some people have an interest in unit trusts. Unit trusts on an overall level is very small; it's 6%. Okay, so I kind of haven't put it on the graph. However, when you get to the upper income groups, especially the 40K plus household income, you see about an 18%. For unit trusts, and that has shown a significant increase year on year. And our last line tracks those that have no form of formal retirement savings. So what do we mean by that? Those that have neither a pension provident fund nor an RA. That was our definition there. So we dedupe those two numbers because some people might have both, and this is the number that has none. If we break that number, that same red line of having neither, into the different income categories, this is the picture. So the lower income, understandably, the lower income have the percentage of having no formal savings, retirement savings. Right, this is a new question, and quite a fun one, actually. We said to people, right, so if you got a monthly salary as a windfall, bonus, what would you do with it? Okay. And obviously we needed to word it in that way because everyone earns a different salary. So we couldn't come up with a number. And our clever research house said, right, let's do it this way. So so it doesn't matter what your salary is, you could just got a monthly salary, and then what would you do with an annual salary windfall? So this won't add up to 100, the dark green and the light green lines won't add up to 100 because people can say they can do more than one thing, which a lot of people do. But interesting, and I won't read every single one off for you, but I thought it was quite interesting put in the different geographies, there were also some interesting differences in terms of what people would do if they said spend it. So that green line of 74% for monthly salary, they said, yeah, I'm going to spend some of it or all of it. I just looked at the three main geographies, the Gauteng, Cape Town, and Durban, and those are the different things, the main thing that people would do. So in Gauteng, it's on food and groceries. In Cape Town, it's clothes. And Durban, it's household durables. Just a bit of a fun look at that. But getting back to what this is telling us is perhaps, you know, I suppose there's different takes. The mindset of people to sometimes focus on the short term. Spend it. Okay, pay off debt's a good one. Invest in shorter term investments, or invest in longer term, and that comes more into the fore when you see an annual salary. And I suppose the question or the insight around that is the less money that you may get as a windfall or a bonus, kind of that determines what you're going to do with it. But even those little bits, and we all know at the end, count. So gift to children's quite an interesting one, and try and remember that when we look at the high income, and whether the children of high income parents can expect or not expect to get money from their parents. Right, main source of financial information, this is still the overall sample, bank consultant. So if I need financial information, I go to my bank. 34%, word of mouth is 20%, financial advisor 18%, that's any financial advisor. And then people that weren't, that said they wouldn't consult an advisor. Why would you not consult a financial advisor? It's because I'm embarrassed. I don't think I have enough money. I've got such a little, why would I consult a financial advisor? So that was the insight there. Interesting in Cape Town. Cape Town's a country on its own. Word of mouth is the most. Word of mouth is the most popular main source of financial information. Okay, and I did ask 2 people about this week when we were doing a little bit more in depth. One was a journalist and one was one of our own people, and they said yes, because in Cape Town it's very cliquey. So word of mouth, absolutely, they can understand. Okay. All right, informal savings. So those of you that are interested in the kind of stokvel market and the informal savings. So when we look at informal savings, 90% of our sample that say that they contribute to informal savings are black households. And we've just broken it down here for you with stokvels, burial societies, and grocery schemes. What's happened to that over time, the trend lines? You can see slightly less in stokvels, slightly less in grocery schemes, and then burial societies, grocery schemes remaining pretty consistent. However, when we say slightly less, it is still significant. 45% of black households are contributing to at least one stokvel per month. You would have seen those that were with us last year. We showed this slide, showing it again for emphasis, what the potential estimation, and this is our estimation on a formula that we've worked with, in terms of what the stokvel market could potentially be worth. This is not worth as money that is either in the bank or under the mattress. This is the overall. So absolutely some of this money would be banked. Some maybe not, but that's the size, a very significant sized market. Let's look at the incidence of contributing across income levels. Right, so very significant across all income levels, stokvels in black households. What we do see is a pullback in the less than 6K per month, up top there, 50 to 39%, and in the top end at 40K plus. Some of the more in-depth work that we've done, in the less than 6K, the hypothesis is that it's just, I'm really strapped at the moment, and I need to pull back on even contributing to stokvels. That's really the hypothesis there. In the upper income group, I'm not that certain. I don't know, but certainly we see in the middle income groups, the other 3, some even doing more into stokvels. Generation Y, Generation X, and baby boomers, what's happened there with stokvels? This is, of course, amongst black households. So we see Generation X remaining pretty consistent, baby boomers pulled back, and the Y generation. Baby boomers, once again, I think the hypothesis there is that things are just a lot more difficult. I'm not sure about the Generation Y, but there seems to be something there, and we'll track that going forward. Right, so what is the amount? This is one place in the survey where we do look at amount. What is the average contribution amount that people are putting into stokvels per month? 685 Rand. All right, and that is the breakdown across the different income categories. And then all I've done is I've worked that out as a rough percentage of income. Right, so in the bottom end, less than 6K per month, 7.4% is not something to be sniffed at going into stokvels, and then 6.7, and then it decreases as we go up. That's quite an interesting insight as well. Where have we come from? In 2011, the average amount that across the board that was being contributed to stokvels was 520 Rand. We're now at 685 Rand. It's about a 31% increase over 3. It's actually 2.5 years, because that 2011 was a November 2011 score. We also broke the stokvel contribution incidence, I can put that down, by public and private sector. A year or two ago, we were asked to do a cut on the public sector, and it's now been kind of ingrained in the survey, so we have that data as well. And very interesting picture here, where you see the public sector and the incidence of contributing to a stokvel gone up quite significantly, from 47% to 63% year on year. And then private sector, less of a pronounced change. One of the reasons, and I'm preempting a little bit of what's to come, is we see that debt, incidence of having different types of debt has increased in the public sector as well. So perhaps one of the hypotheses again is that the public sector employees have increased their level of debt, therefore it's more difficult to get more debt, and maybe they are looking at more informal ways of getting access to funds. Just a thought. Right, let's look at dependency. This is every year, we've got this tracking going back right to the beginning. It's a statement that says, my children should look after me when I'm old. And back there in July 2010, it was 26%. And we're now sitting, you can see even with a little bit of a blip there in 2012, at around 39%. Okay, rather concerning. And yes, there are racial differences. Yes, there are income differences, but probably not as much as, well, not to the extent that you think. And I'll show you some of that now. Here's the income differences, or the income percentages. So at the lower income levels, 1 in 2 think that their children should look after them when they are old, and about 1 in 4 in the upper income. Just another bit of information. No, I'll mention that when we get to the sandwich generation. That probably fits in better. And then this is the generation Y, X, and baby boomers. You can see baby boomers, almost 1 in 2, thinking that their children will need to take care of them. And we have some vox pops for you, voice of the people, a little bit later on baby boomers specifically around this question. So we'll see what some of them say. Dependency on the government. The government will take care of me if I'm unable to take care of myself. And yes, people do ask us, is this holy? So do they think that the government will take absolute care of them with everything, or is it partly maybe with their old age pension or whatever? And yes, it's all of that together. We haven't separated that out. But I think just the sentiment and the consistency of this data is quite interesting. So 1 in 3. The slope here between upper and lower income is a lot more pronounced, but still rather worrying. And what's worrying, what I think is fascinating, is even in the Y generation, you've got 1 in 3 saying, yeah, so these are the younger people. These are the younger people coming up into the market. These are working people, and there's no difference between this. And I would have thought maybe the younger generation would have said, no, I can see what's happening there. That might not happen. Very interesting, this insight. Our sandwich generation, just to reiterate, those people who are sandwiched between providing for dependent children and providing for dependent parents or older family members. Stayed pretty consistent, but there are differences in, and I'll show you now, in income and generational differences. The boomerang generation, we haven't included it in here, just to let you know who they are, because there has been a change there. These are the children that leave home, either get married, go out and live on their own, and then decide that life is much better and cheaper at home, and move back home. That generation we've tracked is currently sitting at around 17%, and that's an increase of about 4% over the last 2 or 3 years. So it is on the increase for various reasons and obvious reasons that I think home cooked meals are probably better than takeaways. Sandwich generation. Just to show you across the different income levels, and we see quite a big spike this time, 30% sandwich generation in the 20 to 39 or the 20 to 40K category, and also in the age, the 31 to 39-year-old category. Right, debt. Now, these lines probably don't show perhaps clearly that everything's on the increase. But if one just looks at July 2013 and July 2014, and we look at various debt levels, we've only presented 3 of them here. We look at bonds, mortgages, we look at installment sales, etc., etc. We've just shown credit cards, store cards, personal loans, and you can see, even though the percentages may seem small, there's definitely the signs of increased incidence of having these types of debt. So store card, 62 to 65, credit card 29 to 33, and then personal loan 17 to 20. And yes, there are differences in income, in the income breaks as well. Personal loans, just to show you the split of in which income category, where people have personal loans. So highest in the 14 to 20K category, but also then the 6 to 14 and 20 to 40, and even the 40K plus is not insignificant. Higher purchase, just out of interest, and we have seen a bit of an upkick in terms of higher purchase as well, specifically in the lower and the middle, kind of more middle income categories year on year. Employment sector, public sector. This is what's happened there. So credit cards from 39 to 52, store cards, the top line, and personal loans. And so if you remember back to the Stockfell slides, there may be something in kind of looking at these 2 bits of information together. If one looks at the private sector, the lines are a lot flatter. All right, our baby boomers. So born 1964 and prior, and a really, really stressed generation at the moment, and not only in South Africa, across the world. Any reading that you do or research that you do, you'll see the baby boomers is definitely a financially stressed lot of people. So let's look at some of their dependents. 57% have dependent children, right? And that is predominantly their own children, because we do ask, are these your children or are they somebody else's children? Predominantly are their children. 29% have children younger, so in that group, than 12. So these children are still going to be going through primary school, high school. And of course, I mean, the reasons around this, people having children later in life, that's really where this would stem from. And then have dependent adults, 23%. Those are mainly their own parents, but there might be other aunts, uncles, sometimes even grandparents, because people are living longer. What are they saving for? So what were the winners? Funeral expenses also was one that we saw a little bit of a kick up. End of year as well. And we saw that the retirement and old age was certainly a loser, and it was the lowest level that we've seen since 2009. okay, of contributing to or saving for retirement old age. And then home improvements and children's education. Right, some other facts about the baby boomers. 50% of them, 1 in 2, have life assurance. 49% have some type of medical cover. So it might be medical aid, medical insurance. That still means there's 50%, 51% that don't have. 59% contribute to a pension or provident fund, and 37% to an RA. And when you dedupe that, you get just on around 29% have neither. No form of formal retirement savings. And then in terms of bank cash savings, it's at 38, and it's once again the lowest level since we've seen since 2010. In our black baby boomers, this is really just a repeat, but we saw that Stokvel contributing to a Stokvel, which has also taken a slide. But those that do contribute about 670 Rand a month to the Stokvel. Credit cards, baby boomers and debt, highest level since 2009. Credit cards, 17% of them have a personal loan from a financial institution, an overdraft, and 10% higher purchase. So also signs of stress, once again, in this generation. Confidence in managing financial affairs. It's at a 7, which is a mean score. You could say, well, that's not bad. But it was at a 7.8 in 2010. So a decline in that score as well. Some of we don't only just do hard figures. Sometimes we look at for various questions, we look at the in-depth info and what people are saying. We interview 1,000. This is just some of it, and I'm not going to read through them, but just to show you some of the real issues that this generation is facing. So the first one is around a new grandchild in the house. So I can't save because I've got to look after the grandchild. Typical of maybe a boomerang generation, a sandwich generation, etc. Other one, she obviously stood surety for somebody or applied for a personal loan and then couldn't pay it, so they're sitting with that. On the bottom is getting rid of animals and cutting back on luxuries, lots of debt. And then for the first time this year, we've picked up in this kind of the informal savings side is this issue of risk. So while informal savings have all the benefits that go with the whole process, we also started picking up a bit on, but it's actually a little bit risky, because what if that person who manages the Stokvel or the Burial Society absconds, then what happens to my money? So that was quite an interesting insight, so the other side of all the benefits. Dependency on children, a clear picture, right? 46% of baby boomers say that they will be dependent on their children.
I do think I will need support from my children for the reasons I stated earlier, that the cost of living keeps on rising, and I think pension contributions are just not keeping pace with the cost of living.
At this stage, I hope not, but I think maybe they will have to not look after me, but help me one day.
I think to a certain extent, with the cost of living that's gone up so highly, luckily my kids have all got degrees and self-supporting, but now and then they help out with a couple of rands and stuff, and I think it's only going to get worse as I get older.
I think to an extent, yes. It's because, as I said, a small contribution towards a small pension fund. So yes, I would be dependent a little bit, yeah.
No, I don't think so. Normally with my custom, I think it's the father's responsibility to take care of the kids, not the kids doing way around.
I hope to God not. And I will find a way of making that possible despite the dreadful situation I'm in.
Right, budgeting and financial information. So what are our baby boomers' main source of financial information? Bank consultant, financial advisor, 21, and word of mouth. Once again, similar picture. Why would they not consult a financial advisor? Because they feel they don't have enough money. And we also added some budgeting questions this time around, do you make a budget? Do you make a weekly budget or a monthly budget? What do you check? Do you check your cash slips? We did kind of a whole thing on budgeting, and 27% make no budget at all, either on a weekly or a monthly basis. So they just kind of live day to day. Right, so that was our baby boomers. I'm afraid not such a great picture. I did say that we would have a brief look at our high income market. And this one, we just need to note that we, for the purposes of this research, have defined the high income market as personal income of 80,000 K plus per month. Now, before I get into the results, I need kind of just to let you know that finding these people is quite difficult from a research perspective. When you find them, you have to get them to agree to be interviewed, which is the second hurdle. And the third hurdle, we try to get some vox pops of them, but there's no ways. Okay. Of course, every person in that vox pop has signed an agreement that we can use their filming publicly. And of course, in this market, nobody's prepared to do that. So it works out to be quite a costly exercise. But right, let's go into it. So let me just explain according to the statistics that we have on hand, over 70%, between 65 and 70% are Gauteng-based in this market. Okay, so it was skewed towards Gauteng. And also, it is largely white-based in terms of race. All right. In terms of age, which we've shown here, which is quite interesting. So we do have 5% of 5% in the 30 to 34-year income break, but then certainly the majority in the 50 to 64. Remember, these are working people. And then female-male split is skewed towards male. What are, remember those 4 metrics that we spoke about up front? So the first column there is what you saw overall for the overall sample, and this is where, and then the bottom one is for the high income, or sometimes we call it the wealth market, and confidence in making financial decisions. You can read down these results. What I found quite fascinating was that even earning that amount of personal income per month, the confidence in making financial decisions is only 7.1. Okay, it's only 0.2% up, or not 2%, 0.2 up on the overall sample. And then satisfaction, they're a little bit more satisfied, but not that satisfied. And then expectation of financial situation improving in the next 6 months is maybe a bit more realistic, 29, compared to a year ago, 20% said it was better. Quite a positive picture, I'd say. What are they saving for? Okay, so you've got retirement, old age on the top, but then you've got holidays very, very closely. after that. And yeah, these guys, when you look at some of the data, it's all around, I want to have the experience, I want to travel, I want to go to weird and wonderful places. So quite a lot into holidays and travel, then emergencies, home improvements, and also Christmas, end of the year. Obviously, that is all relative to what your Christmas experience, what Christmas experience you want. So 19%. What products are they saving in? You've got retirement annuities at 99%, 100%. Life assurance high up. Pension and provident fund, interesting, 56%. Remember, these are working. However, one needs to also remember that there's a higher proportion of self-employed in this market. And we'll come on to that in a few slides. Lump sum investments, endowment policies, funeral policies, and education policies, also quite low, remembering that these are, they're kind of more baby boomer, but there are quite a lot with dependents. Investments, unit trusts, mutual shares, ETFs, 68%, shares and offshore investments, and then precautionary savings. They've all got short-term insurance. Medical aid or medical insurance would cover the medical side. What is their confidence in the South African economy? Quite a lot lower, 37%. Unfortunately, I don't have anything to compare it with because it's the first time we've done this market, but certainly in future we will track that. Right, this is their breakdown of percentage of household income spent on different categories. You can see there 47% on consumption would make sense because they earn more and you can only eat so much and do so much, I suppose. 19% is on debt, quite a lot, and go to debt servicing. And then insurance and medical aid, quite a lot as well, but it's all relative, and then savings, 20%. My children should look after me when I'm old. Just 7% of them, that their children should look after them. This is their saving more or less than they were a year ago. And 70% about the same, so a very consistent picture. And expectation for the next 6 months stay the same, and quite a lot of them saying it will improve, and then compared to a year ago. This is living comfortably. Remember that indicator that we had? Living comfortably, remember, was 9% for the overall sample, 33% here. And then this is the breakdown of the confidence in making financial decisions. So you've still got 22% there saying, not so confident in making financial decisions, and that we saw from that mean score of 7.1. Some other interesting facts about the high-income market. So 27% have a holiday home. 18% are rental property. 71% have consulted a financial advisor in the past year. 12%, quite an interesting one this, have dependents other than children and close family. So this might be, I've taken my helper's child and I'm putting them through school, or that's kind of the majority of what's in here. 85% will rely on their property to fund some or all of their retirement needs, compared to the overall sample, which was 25%. And then 28% are self-employed, compared to the overall sample of 12%. Okay, and then debt, even 11% have a personal loan. All right, what would they do with a windfall? A little bit, if I could say, a little bit more responsible. Those that have a bond would put it into their bond. Some would spend it, absolutely, but look at these poor children. They're going to get less. So, less giving to children. But yeah, I suppose they, because of their situation, they are more responsible. Right, Africa. And then I'm done, and I'll hand over to Riaan. Africa, as Mokgadi said, we went in for the first time this year, end of last year, to do Namibia, Kenya, Zimbabwe, and, did I say Nigeria? And I'm not going to go through each of them, don't worry, and I'm only taking certain snippets out of the full deck for these countries. So, I feel confident about the economy of my country. The light green is South Africa. Remember, our overall figure was 52. That is the figures in the other countries. The Namibians are quite a confident lot in their country. And Nigeria, not so confident. although they kind of overtaken us as the leading economic force in Africa, but not that confident. Kenya and Zimbabwe, also on Zimbabwe on the low side. My children should look after me when I'm old. I thought we were quite significant at 39%. When I presented this to the different countries, I said, I think we have a problem with these results because there's something not right. And especially on this one here. And they looked at it, they said, oh no, absolutely perfect. We would have expected it to be 100%. Okay. So Namibia, my children should look after me when I'm old, and Nigeria at 96. They said, yeah, no, that's perfect. We did obviously sense check all these results and involve the countries in the surveys. I'd like financial advice, but it's hard to find somebody you can trust to give it to you. So even though Namibia is confident and their children should look after them, they have quite a lot of trust issues there. Because remember, this is a negative. I'd like financial advice, but it's hard to find someone you can trust to give it to you. And then one would need to unpack and find what's happening there. And then saving for education is more important to me than saving for retirement. Okay, we didn't cover that in the South African results. So there's lots of stuff, data we didn't cover, but just interesting. So very big focus, education. Namibia, Nigeria, in fact, all. Very big focus on education. Products held. All right, so only some of the products we've put here. And the Nigeria results are correct. Okay, so every time I put the slide up, people say, oh no, there's something wrong with the Nigeria results. They are correct. Very, very low formal financial involvement. And the red line you see there of the 83 is those that have no formal retirement savings, so neither pension provident nor RA. But of course, there might be other types, which is not represented in here, but this is the formal side. So very interesting as well. You can also see that in Nigeria, the funeral policy plans 0. And this is from our Nigerian colleague who said, you don't talk about death here. So he was totally confirmed that that would be the result. So just fascinating, the different kind of cultural emphases and that go on in our neighboring countries, and specifically the countries that we operate in, and all the more importance to understand them and know what's going on. Okay, this was satisfaction with current situation, current financial situation out of 10, and the confidence in making good savings and investment decisions. So we're not doing too bad comparatively. The Zimbabwe is really not satisfied. Zimbabwe respondents, not satisfied. But Kenya, the confidence, Kenya with South Africa, the confidence in making good financial or good savings and investment decisions is the highest. And then lastly, I think this is the last one, on Africa is who do they, the top 3 sources for financial information. Remember, ours was bank consultant, word of mouth, and financial advisor. And certainly in Namibia, bank consultant is also prominent. And then one starts going, look at the word of mouth in the other countries. And television in Kenya, a large focus on television. They say that's where they get their info from. And Zimbabwe on newspapers. Employment, fascinating slide. This self-employed, I mentioned this 12% to you for South Africa, and employed in the public sector, and look at Nigeria and Kenya for self-employed. Okay, and that most often is self-employed in more than one entity. Right, that Mokahedi has already spoken about. An investment in knowledge always pays the best interest, and without the information and the knowledge, we can't give the best to our consumers, our clients, etc. I'm going to end off before I hand over to Rian. We asked our people, our Vox Pops people, as a final parting word, if you were advising the youth of today on what they should do with their finances and how to manage their finances better, what would you tell them? And that's how I'm going to end off.
Save, 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 and save much more. Stick to what you need. Stick to your budget. Don't overspend unnecessarily. But save.
I think don't be a rolling stone. Stay with your job and get always something in the bank. I think when you're young, you don't think you're going to get old, but time flies, and then when you realize you are at that stage that you thought you will be totally, you don't have to work, and then you see that you actually have to work still.
To look after your old age, definitely. Not just buy cars like I used to do and spend all your money on diving and flying and doing the luxury things. You definitely need to look after your money. But when you're like 20 years old, it's very hard to see that.
Don't wait for the next 10 years to come. If you've got any money that you think you're not going to use, start putting it into a certain account, and or even if it means investing it, and make sure that it will make sure that when you now need the money, you will be having the money.
Never start any credit or anything. Try to buy things on cash and save money. Or if you want to buy something, save money in order to buy that thing. Don't buy anything on credit.
Well, obviously I would suggest that they get into the property market as quickly as they possibly can. And secondly, we often say there isn't money to stash away, but actually there is, and it's a question of tightening the belt and stashing the money away and making sure that you do get onto some sort of a pension plan, provident fund, retirement annuity or whatever, and be disciplined, do it.
Is not to go overboard, get what you need, not what you want. Save, and save.
You just have to...
If you feel depressed after the next talk, wait till I'm done. I'm going to talk a little bit about savings from a macroeconomic perspective. Why is savings important for the economy as a whole? And what happens if we don't save? Then I'm going to talk a little bit about the problem in the South African economy. Why is the economy not growing? And then I want to end off a little bit talking about households, individuals, and saving. Now, just a reminder as to who saves in the economy and why do we save? Well, households save, and they save to finance the future liabilities. Whether that is retirement or whether that is a daughter's wedding or kids' education, doesn't matter why you save. It's to cover some future liability. And it means you forego a part of your current income to be able to spend later. When companies save, company savings is simply undistributed profits. So when a company makes a profit, it doesn't pay everything out in the form of a dividend, it keeps some of it back. And what's kept back is used for investment in the business, to expand or to replace things and so on. Government saving is when government tax revenues exceeds its current expenditure. So, in other words, the excess of current income or tax revenue over current expenditure is then used for physical and social infrastructure investment. So when does a government dissave? Our government's been dissaving now for a number of years. When it actually borrows money over 10, 20, 30 years to pay wages and salaries. I mean, that's the same as you go and you buy your monthly groceries and you build up debt to finance it. You can do it, for so long and no longer. So government needs to become a saver. It needs to spend less on current expenditure and spend more in investment. For a nation as a whole, of course, if you add the three up, you get the total savings for the nation as a whole. What is savings used for in any economy? Well, it's used for investment. It's used for physical infrastructure, it's used for investment in businesses, it's used for building roads and bridges. So what happens if we don't save enough? Well, if we don't save enough, there's not enough money for investment. Investment will not occur. Investment is the backbone of economic growth. No saving, no investment. So the interplay between saving and investment, just a reminder of this also, that savings, having enough savings, is a necessary but not a sufficient precondition for investment. Put differently, you can have as much savings in any economy as you want to, but if business conditions are bad, economic outlook is particularly poor, companies will not invest. In South Africa today, you find that South African companies sit literally on hundreds and billions of rands on their balance sheets, and they're not investing. Why aren't they investing? Because the business outlook is not particularly good. So we need to get a good business environment for companies to actually invest. But also, the reverse is also true. So while having enough saving does not necessarily guarantee investment in the economy, also, if you have a good set of business prospects, you may have a lack of savings, but you will still get the savings. It will come from abroad. Take India today. After the recent Indian elections, there's been a surge in optimism about Indian prospects because everybody thinks the Indian government will introduce economic reforms, the economy will grow faster, and despite having a saving shortage, capital is streaming into India. So just as a reminder on this one, you need savings for investment. If you don't have enough savings, somebody's got to provide the savings for you. Now, anybody that's done a bit of economics 101 will know that the gap between saving and investment in the economy is equal to the balance on the current account of your balance of payments. Now, here's a graph of our saving and investment as percent of GDP. This is savings percent of GDP or investments percent of GDP, and the blue line is saving. The gap between the two is equal to the deficit on the current account of balance of payments. What it means, in short, is where we stand today. Our current account deficit is about 6% of GDP. That means, in rand terms, we need 200 billion rand of capital inflows every year to plug the gap. If we don't get the 200 billion of capital inflows, the rand will just continue to fall. Alternatively, if the rand keeps on falling and you need to close the gap because you can't get the capital inflows from abroad, how do you close the gap? You either raise domestic savings, which is not that easy, or alternatively, you've got to depress investment, which harms economic growth. How do you depress investment? Saving shortage, interest rates go up, cost of capital goes up, and investment will fall. That's what happened in these years here, in the bad old years of the 70s and 80s. So we need savings more in this economy to finance our need for investment. And bear in mind, the NDP puts a target of investment as percent of GDP at 30% by 2030. So this is where we want to go. So, blue needs to follow. We need to save more. If we don't save more, interest rates will just simply have to be a lot higher. Now, a year ago at this very presentation, I put the slide up. The rand had just gone from 8.25 to 10 over the previous about 12 months. And I put this graph up and I said, well, why are foreigners concerned about South Africa? There's the whole list. You've got it in front of you. I think it's in your packs. And there are 10 reasons why people are concerned about South Africa. The current account deficit is large. Portfolio flows may dry up. The budget deficit is large. Growth is slowing. Labor troubles. Electricity shortages, employment, not creating jobs. Inflation, risks to the rand. Politics and policy, and the Reserve Bank's in a difficult spot. Now, if you update this chart where we are today, over the past year, these have all remained bad, or they became even worse. If you look at the current account deficit, it's narrowed a bit, but the deficit remains large. We still need about 175 billion rands of capital inflows to plug the gap. Secondly, portfolio flows, they're still positive, but they become a lot more volatile and they're a lot slower. Hence the persistent weakness of the rand. The budget deficit, we're looking at yet another year of slippage. We've been promised now year after year after year by government the budget deficit will shrink. It is barely doing so. And this year, with the economy, 0.4, slowing further than we thought at the beginning of the year, the budget is under even more pressure. Just bear in mind on economic growth. Beginning of this year, the Reserve Bank and the markets forecast for GDP growth in South Africa for 2014 was 3%. We've now revised that down to 1.5%. And with the NUMSA strike carrying on, I see they've just announced that they're going to continue striking, the likelihood is the growth in the economy will be 1% this year instead of 3%. That will put even more pressure on the fiscus. Labour troubles. It's far worse now than it was even last year, and far worse than the year before that. Electricity shortages. Eskom has sort of averted major blackouts, but the bind remains. If you can't have electricity, you can't expand the business. You need electricity. Employment. Weak growth and the strikes that we're seeing at the moment, the labour troubles we generally have, is not conducive to job creation. It's simply not going to happen. Inflation. It's surprisingly muted, given the weakness of the rand, but the pressures are building. The Reserve Bank is sitting in a very difficult spot. The last point there, inflation is out of the target range, but growth is weak. What do? At some point or the other, companies will have to pass on some of these costs. That means inflation will remain sticky. And politics and policy, hopes remain of NDP implementation, but expectations are generally pretty low, and I'll come back to that. So the trouble is foreigners remain concerned about South Africa. Now, what does it have to do with savings? Well, it has a lot to do with savings because essentially Those 10 concerns boil down to 3 broad ones. The first is that South Africa is caught in what is called a slow growth trap. This economy just simply cannot grow fast. And therefore, we have little employment and a sustained heavy dependence on government. Now, of course, if you have that, a slow growth trap, people remain dependent on government, not a lot of job creation, what happens with savings? The ability to save in the economy is very low. Government cannot save because it consistently has to spend more and more and more on the social wage, that is grants and so on. Secondly, no job creation means dependency ratios will continue to rise. It'll become even more difficult for people to save. And of course, companies will not save because why should we save? The outlook for the economy is bad. And that means savings remain in shortage. That's the first problem. The second one, we continue to sit with big deficits. Big current account deficit, a big budget deficit. And of course, when you sit with these big deficits, at some point or the other, foreigners say, we are not willing to finance that for you any longer. And when that capital starts to leave, you could potentially end up in major trouble. Just as a reminder, we need, as I said earlier, 175 to 200 billion rands of capital inflows just to plug our shortage at the moment. But bear in mind also the stock of assets that foreigners hold in South Africa. Foreigners hold, I estimated a while ago, about $250 billion in the South African equity market and about $45 billion in the South African bond market. Now that's 300 billion odd dollars that they own here. We own $50 billion of foreign exchange reserves. If they all decide to leave because they become really disillusioned about South Africa, the rand will really collapse. So we need to get growth going in the economy to ensure that we continue to attract capital from abroad and to increase the ability of the economy to generate more savings. And of course, the third point there, if you're in a slow growth trap and you're faced with big deficits, the social and fiscal pressures would just continue to rise, which it has been doing over the past number of years, hence the downgrades from the rating agencies. We need to break out of this. And the question is, how do we do that? Now, this brings me to the South African growth picture. This is South Africa's GDP growth. It's a 5-year moving average of the annual GDP growth numbers. Annual GDP numbers are very volatile, so I put a 5-year moving average through it. It tells you a story. In the 50s and 60s, the economy grew very rapidly. Pretty volatile, but around a rate of 5 to 6% per annum over this period. Of course, South Africa is a trading nation. Imports and exports account for 50% of GDP. So you isolate a small open economy and, it should not surprise you, growth collapses. Then, of course, we broke out of isolation, early 90s. Economy recovered a bit, but not really that fantastically. And then we had the growth surge 2003 to 2007. But after the global financial crisis, growth has slowed one way, and we're now sitting with a growth rate of around 1 to 2%. We are searching for a new growth model, just like many other developing countries are. So let's first have a look, try and answer what's the problem with the South African economy. Let's first go back to the 1960s. Why did the economy grow so fast in the period of the Second World War until the late 60s? Well, the answer is very clear. This was mining town. Now, this is South African mining GDP, and you can see the growth rate 50 to 1971 was not that great, about 5% per annum. But bear in mind, South Africa produced about 200 tons of gold in 1950. By 1970, it was 1,000. Today, it's back at 200 tons. So gold mining is basically dying in South Africa because there's no more gold to be found. Other things are rising, but the problem overall is South African mining production today is 20% lower than it was in 1970. And remember, this period here, when you had this massive boom, the forward and backward linkages to mining in the economy is massive. You could see that from the recent platinum strike. It was not only platinum production that got hit, manufacturing production got hit very hard because manufacturers that supply into the mining sector and that feed from the mining sector got hurt very badly. So, of course, when you have this kind of boom, 1950s and 60s, what do you get? You get manufacturing booming. That grew far faster than mining did. And, you get this kind of growth in mining production, it all gets exported. What happens? It's not long before you run into capacity constraints and you get an infrastructure boom. It was in this period here when the Sisson-Saldanha line was built, when all the electricity plants up in the north were built, and so on and so on and so on. So, you get a booming sector in the economy, and it drives a whole lot of other things. If you look at the economy today, mining is not booming, it's going nowhere. In fact, it's an industry that's really battling. You cannot really see mining production in South Africa, recovering significantly. So, how do we grow this economy? we need to get the manufacturing sector growing. And to do that, we need to be internationally competitive. And with the kind of labor troubles we have at the moment, and the cost pressures of this economy, including electricity, is not the kind of environment that makes you particularly competitive. So then you can ask yourself, now, okay, now what happened here? Why did the economy grow so fast here? We eventually got to, on a 5-year rolling basis, to a 5% GDP growth rate. Well, the answer is very simple. It was just a combination of 3 things. Firstly, the global commodity price boom. The global commodity boom didn't benefit our mining exports. It benefited the prices. So, but that had a big positive impact on the entire economy, like a positive income shock. And then, of course, at the same time, we had the infrastructure drive on the part of government in the run-up to the Soccer World Cup. And then, of course, on the back of all of this, surging commodity prices, rand is strong, inflation falls, interest rates fall, you get a consumer credit boom. Now, the global financial crisis, which happened in 2008, stopped all 3 dead in its tracks. So, you know, there is no more global boom. The world economy is struggling. Commodity prices are actually drifting lower. The infrastructure drive by government is basically ground to a halt for several reasons. Government's talking big numbers in the next 3 years, but there's no growth in the numbers. Government's going to spend 800 billion in the next 3 years. They spent 800 billion in the past 3 years also. So there's no net growth in the numbers. Yes, it will help to unblock certain problems in the economy and blockages in the economy, but there's not a lot of growth there. And of course, there is no consumer credit boom. It's the reverse at the moment. Consumers are deleveraging. So, given what's happened here, what we now know, if you look back, people are getting very excited South Africa is breaking into structurally high growth rates. You now look back, you realize these were all just temporary things that are not going to repeat themselves again. So we need to find a new growth model. We need to become globally competitive if we really want to grow this economy faster. Now, let's just stand a little bit back also and say, well, how bad is a 3% growth rate? Well, it's not that bad, because you've got to compare that with the population growth rate. Population grew at about 3% per annum in the 1950s and 60s. Population today is growing at a rate of probably less than 1%. And just bear in mind also, a 5% GDP growth rate with a 3% population growth rate is as good as a 3% GDP growth rate with a 1% population growth rate. Your real standards of living can still rise by about 2% per annum. And if you look at, this is real disposable income of households per capita, you can see here, the slope of this line here, the 50s and 60s up to the early 70s, I just copy that line in here, it's exactly the same slope. So that tells you, you grow at 5% with 3% population growth rate, that's as good if you grow 3% with a 1% population growth rate. So 3% may not be as bad as we think. The trouble, of course, is that if you take this line and you extend it, you get the following. If we had continued to grow at the rates we did in the 50s, 60s, and early 70s, South Africa's GDP per capita, or disposable income per capita, today would have been 50% higher than it actually is. And you would have ended with a much, much lower rate of unemployment. So the fact of the matter is, we need to get this growth rate up so that we can grow at a much faster pace to address particularly the unemployment problem. So we got massive backlogs, and we need to address those, and we need to get to a much higher growth rate in the economy. The other problem, of course, that we have in the economy has been growing at a reasonable rate, but it's done nothing for the unemployment rate. Unemployment rate remains stuck at 25%. And if you include people that have basically given up, they're unemployed, but they've given up trying to find a job, we sit with an unemployment rate of over 35%. So we need to raise the growth rate in the economy to create more jobs, but at the same time, we must also improve the labor absorption capacity of the economy, the willingness of the private sector to hire people. Now, a particular problem in South Africa, it's a worldwide problem, but in South Africa it's particularly acute, is the youth unemployment rate. This is now for 15 to 24-year-olds, and it sits at over 50%. And that is despite the matric pass rate, these are government numbers, going from less than 50% to 80% today. The improved matric pass rate has done absolutely nothing for the youth in terms of finding employment. In fact, in recent years, it's gone up even further. So this tells you there's a fundamental problem here. There's a structural problem in South Africa that needs to be addressed. And what's the problem? The problem is that our job seekers are facing huge obstacles. What are those obstacles? We're getting better quantitative pass rate, yes, the matric pass rate goes up. But in terms of supply of skills, quality to the economy, that's not happening. The quality of education in South Africa is particularly poor. We sit right at the bottom of the global surveys. So we need to improve education, and we cannot afford to play games with education any further. It needs to be improved now, because the lead times are very long. Another problem is few, actually, of the matriculants get access to tertiary education, and then the dropout rate is very high. And then for the rest, of course, finding a job is extremely difficult. Secondly, our troublesome labor environment is a massive obstacle to job seekers. There's no question that the private sector tries to get away from hiring people as fast as they possibly can. The kind of troubles we've had in the mining sector, a strike for 5 months, and now again, in the metal industries, it's not the kind of environment that creates a lot of jobs. Quite the contrary. And what the IMF also said last year in their last report on South Africa, which was released October last year, it had a whole survey, a couple of pages, on South Africa's jobs challenge. And it then compared South Africa with a number of other countries that they regard as high job creators. And they said, and I quote from that report, South Africa does not exhibit the characteristics of fast job creating countries. And it's interesting in the recommendations that they made. Some of the recommendations that they made is be careful of a minimum wage, economy-wide minimum wage, something government is contemplating implementing. It said encourage labor brokers, not do away with them, encourage them. So there are a number of things that they actually said that we should be doing, including another one that I recall was do away with industry-wide bargaining. This thing that we have in South Africa, we have a set of negotiations and it goes for 10,000 companies across the entire spectrum. It's ridiculous. It's not the kind of environment that will create jobs. We need to change these things if we are going to create jobs in the economy. Now, what does the data tell us? The data tells us what I'm saying is precisely right. This is a graph that comes from Macquarie Securities. And this is the so-called capital labor ratio in the economy. And what it says, it's the units of capital per unit of labor used in all production processes. If this line goes up, it means we're using more machines and less people. So where's this line going? It is screaming up. Because how do companies deal with the kind of labor troubles that we sit with? There's only one way. You give people big salary increases, and then you get rid of them, or a portion of them. That's how you deal with it. There's no other way. You've got to remain internationally competitive. How do you do it? This is the way we do it. And this graph comes straight from the Reserve Bank's last quarterly bulletin. And what it plots GDP. It's this line here. This is the level of GDP. And the level of GDP is now like 11% up from the pre-crisis peak. If you look at total employment in the economy, that is exactly where it was. If you look at the public sector, it is exploding. It is 17% up public sector employment. Private sector employment is 5% lower than it was. This is the whole story. The private sector does not want to employ people. Something needs to change here. Of course, the trouble is the government cannot continue to employ people because the budget's already under pressure. That's the current spending part. We need to spend on infrastructure. We're spending on wages and salaries. This needs to be reversed. This needs to be there, and this needs to be there. That's where we should be heading. But that's not where we're heading at the moment. So if you look at the South African economy, you've got to say to yourself, well, the economy is filled with a lot of strengths. It's a constitutional democracy, it's politically stable, got entrenched property rights, contract enforcement is high, independent jury. You can read all those things yourself. I'm going to read to them. We know these things, and you talk to international investors, this is the type of thing that they absolutely love. We got all these strengths. The economy is flexible. This economy is going through many, many, many crises over the past 25, 30 years. We've got a massive mineral wealth. Tourism potential is huge. A very important one, strong financial sector with sound regulatory oversight and deep capital markets. I mean, none of our banks landed in trouble in the global financial crisis. That is a fundamental strength. Institutions have credibility. We've got many world-class companies. Got a young population which is typically perceived very positively by investors. So we've got all these strengths. Why aren't we growing? Why aren't we using those strengths? So what's the trouble? At the moment, the trouble is that we're searching for a growth model. There is no global boom. There's no world economy in the 1960s boom sucked in commodities. There's no commodity price boom China. That's not happening at the moment. So, mining is struggling. There's no sectoral boom. Again, mining in the 1960s, shale gas in America at the moment. It's providing valuable additional growth impetus to the US economy. We don't have that. We don't have a booming sector. There's no infrastructure boom. It's yes, got big numbers from government, but there's no growth in it. I mean, in the period 2003 to 2007, government fixed investment rose at the rate of something like 15% in real terms per annum. It's now doing 2-3. So there is no impetus. Yes, the fact that you're building an additional power plant, Medupi and Kusile, that will help in the sense that it will unblock some of the blockages in the economy. You will be able to get electricity if you want to expand a business. But, again, that thing is 2 years overdue. So there is no investment boom. The private sector is not investing. Why? Because economic prospects are not fantastic. There's no consumer credit boom. As I said earlier, consumers are deleveraging. There's no big pool of skilled, productive, and competitive labor to attract production facilities. That's the Chinese model. What did the Chinese do? They opened themselves up, well-educated people, hard-working people, and they sucked in production from all over the world. Everything nowadays is made in China. We don't have that. And there's no room for monetary or fiscal policy to support the economy in the short term. So one can understand why foreigners are concerned that South Africa is stuck in a slow growth trap. And of course, when you're stuck in a slow growth trap, the trouble and the risk is the pressures keep building. And the risk is you may become eventually either socially or fiscally or financially unstable. Now, what does financial instability mean? Financial instability means your currency collapses. And when the currency collapses, and that's what I'm predicting, that's what I'm saying will happen, but when you get into that kind of crisis, don't think a currency collapse means the rand goes from 8 to 10 to 12. No. It does what it did in 1981. In 1981, the rand, South African rand, traded 75 cents against the US dollar. 5 years later, it was 3 rand. That's the same as the rand going from 10 to 40. That's what the crisis means to you. Go look at South America. In their crisis, currencies absolutely collapsed. So what we need to do is we need to ensure that the growth in the economy is ratcheted up sufficiently so that we stay socially, financially, and fiscally stable. But more than that, we need to attract foreign capital to grow this economy faster. So the question, of course, is, well, what should be done? What needs to be done? Firstly, we need to address cyclical problems. The current account deficit is too big. We're importing too much. We're living beyond our means. It's very nice to have all this fancy imported stuff, but we cannot continue to live like that. We need to be competitive. We need to export more, import less, buy South African-made stuff. And of course, we need to address the fiscal problems and inflation pressures. The inflation rate sits at 6.6. There's no sign yet that inflation expectations are rising, but the trouble is it might. So the Reserve Bank, unfortunately, into a weak economy, will have to raise rates even further. Secondly, we need to address the growing and deep distrust between government, labor, and business. It's absolutely important. You go and look at countries that have been successful. They've managed to manage this thing far better than we're doing at the moment. In South Africa's case, I don't detect that we're making any progress. Seems to me like we're going backwards. We've got to create greater policy certainty, both at the macro and the sectoral level. Policy uncertainty is a bad thing for investment. Investors do not want to invest in a country if they think, a certain set of rules under which you invest in now may change in future. Indian government has had the habit of having retrogressive taxes. They say, well, we're going to introduce this tax today, and it's going to be made applicable from 3 years ago. That kind of thing. They just did away with that. So that's an awful kind. We're not doing that, fortunately. But that's the kind of thing. Policy uncertainty creates an environment where people and businesses do not want to invest. Address South Africa's highly problematic labor relations. It may include elements of the labor law. We may have to change it. I just find it very hard to see, personally, that we're going to create a lot of jobs if this kind of labor environment persists. We need to fix it. Best is, as the President said, let's sit around the table and talk about it and try to sort it out. But it needs to be sorted out. In the absence of sorting it out, this economy is not going to grow and we're not going to create jobs. We need to speed up social and economic infrastructure spend. There's still backlogs, both in the social sphere and the infrastructure sphere. These things need to be addressed as a matter of urgency. Address underperforming areas in the public service. We know all about that. Bad service delivery, crime and corruption that has taken hold in the public service and so on. That needs to be ironed out. That's one area I think where we may well make significant progress and something I'm particularly optimistic about. We need to ensure a more competitive currency, is not undermined by high inflation. If inflation rises because the rand is weak, it doesn't mean we can now all demand higher wages. When the currency weakens, it actually means a transfer of wealth from importers to exporters. That's what should happen. You can't be compensated for high inflation stemming from a weak currency. You need to accept that you have to become poorer. And the people in the export industries need to become wealthier. And targeted support for key industries like the car industry, which has done relatively well. So there's a lot of hard work in front of us. And these things are not things that you sort out very quickly. They take time. So it also means that we don't have time to waste any longer. So can it and will it be done? Well, confidence remains generally pretty depressed and expectations are low. The rating agencies, they actually said it in so many words, that they don't have particularly high hopes for the NDP implementation to go ahead really speedily. So we need to surprise everybody on the upside. So we're all watching government to implement changes and growth-enhancing reforms in the economy. India's case, as I said, optimism is surging in India because the new strong government is reform-minded. And people are saying, well, this is going to create fast economic growth in India. That's the place to invest. We need to do the same thing here. But an opportunity exists. I think there's no question the government's being bombarded from everywhere with calls for growth-enhancing reforms. So a sense of crisis is starting to build. A good plan is on the table. The NDP is a good plan. It's not absolutely perfect. You can debate certain elements of it, but generally it addresses all South Africa's ills and it sort of gives sensible solutions. Politics will give you 5 years of breathing space. We've got 5 years to implement this. The rand is more competitive. The Reserve Bank has shown that it will protect newfound competitiveness of the rand by raising rates. The trouble, of course, is if you fail to reform, that the risks of social, fiscal, and financial instability will continue to rise. The pressures will continue to rise. So we need to do these things. So just to end off with my section, just on South African households and savings, Annette has talked a lot about whether people are saving or why not saving. But from a macro perspective, really from an economist perspective, top down, only two things drive savings. It's the ability to save and the willingness to save. Now, make no mistake, there are lots of people in South Africa that simply do not have the income to be able to save. And they will be reliant on government or on family for the rest of their lives. That is a fact, just a fact. But there's also a lot of people in South Africa that can save but choose not to. And they very often confuse the willingness to save with the ability to save. They will tell you, I cannot save. But that's after, as Lynette pointed out, paying off the expensive 4x4, the expensive overseas trip. And 3 years into retirement, they discover all these nice things they enjoyed the previous 25 years, I actually couldn't afford. Got to make very sure that you understand the difference between having money for something and really being able to afford it. Having money for something doesn't mean you can afford it. You'll only discover 25 years down the line what you could afford the previous 25 years. Read a survey done recently in South Africa, a fairly in-depth survey where they asked pensioners about their financial situation. And 60% of retirees in South Africa said they had a shortfall of income over expenditure the previous year and had to cut back. That's up from 30% 2 years earlier. So the pressures are building. People need to save more. So why do households save? As I said earlier, it's for future liabilities, whatever that liability may be. And most people, well, sounds like most people nowadays, for retirement, they're not saving enough. And a few years into retirement, they discover they simply do not have enough money to live on. Of course, it's a particularly big problem for defined contribution members, increasingly where you find people in South Africa on. And they basically largely oblivious as to whether they have enough money in that pool to be able to provide for a decent retirement. And they discover that a few years into retirement. And defined benefit members don't always realize the risks they are taking with not getting an inflation-linked increase in their pension once they have retired. So it means people need to save more, whether you're on a DC or DB fund, in the run-up to their retirement. Just on investments, I mean, the one thing that you need to remember is when you save for retirement, it's a 30-year time horizon. And on the 30-year time horizon, equities, despite the short-term volatility, has tended to give you far better returns than anything else. Very often you hear people investing over and above their pension funds, putting money away, and the equity market falls 5 or 10%, and they get out of the equity market at the bottom, never get back in again. So, you know, what you should do if you have a 30-year time horizon, forget about market volatility. Forget about ups and downs in the market. If you now look back at the crash in 1987, which was a huge crash, I think the equity market fell something like 35 to 40% in South Africa. Today, you look at it, it's barely a visible blip. So take a long-term view and stick with growth assets, particularly equities, and ignore, to a large extent, the short-term volatility. But not to deal with that, you can look at it at your own time. But essentially, what this graph says is, you know, I basically ran a spreadsheet and said, if a person gets a 9% salary increase per year, and inflation is 6% over a 35-year working life, if you want to retire on 75, you want your first pension to be 75% of your last salary, you know, how do you get there? And essentially what I did here is I said, if you save 13% of your income, only in a pension fund, 6.5% your own contribution, 6.5% your employer, you get an investment return of 9%, which is 3% in real terms, and you take 6.5% of your pension pot at retirement per annum, your pension will only be equal to 32% of your last salary. This is the problem for many people on DC funds. They don't realize that. And they discover that 2 years or 3 years before retirement, when for the first time somebody looks at the pension fund. So, you know, when you save for retirement, there are only 3 things that determine how big the pot is. How long you save for, what's the investment return, and how much you save. The investment return you can't control, and not nowadays, not even how long you save for. So the only thing you can control is how much you save. And essentially what I'm saying is people need to realize that they need to save a lot more than they actually are. So to end off with, summary conclusion on my side, South Africans are saving way too little, and they often make poor investment decisions. How many people in South Africa do we all know? They have lost money in all sorts of schemes. They promised them 1 or 2% extra return, and they lost 100% of the capital. That's a very dangerous thing to do. Poor investment returns always sit in low-yielding money market funds for long periods of time. There is a place in any portfolio for cash, but not over a long period of time when you're saving for retirement. Secondly, the point is that I think many are ill-prepared for retirement, and they simply do not know it. They discover that 1 or 2 years before retirement, or 2, 3 years after they retired. It'll be difficult for many to rectify. It'll be very difficult, particularly if it's late. The best thing to do is to start saving when you know, as soon as possible. And that is not when you start working, that's when you're born. Your parents should start saving for you. I mean, that's an additional 22 years. I mean, the returns over 22 years can be absolutely fantastic. And remember, you know, in retirement, you still need a growing income. That means there's, even in a retirement portfolio, there's place for equities. Let's just end off with, somebody said this to me once, very true. The biggest present you can ever give your children is to never become dependent on them. And what Lynette has told us, lots of people are saying, well, we expect to be dependent on our children. You should give them that present. Don't become dependent on them. And the biggest present you can give yourself is to make your children independent of you. Give them a good education. And with that, lastly, you know, you have to give advice to anybody at the moment. The thing you say to them is fully understand your retirement provisioning. I'm afraid lots of people are walking around that they've got absolutely no clue. Stick with renowned institutions, particularly green ones. Where do you entrust your savings and investment? And you know, get a consultant to advise you. It doesn't matter if you don't have a lot of money, still get a consultant. At least the consultant can tell you don't have a lot of money. Fully understand your future liabilities. People fool themselves very often. They don't fully understand you know, things like the principle of depreciation. You sell your house one day, the thing is old, and you've got to replace everything. So, how often do you drive through a residential area? House is for sale. 2 weeks later, you drive past the house. Only the outside walls are left. They destroyed everything inside, rebuilt the whole place. Who pays for that? It's not the new owner. It's the previous owner, because he didn't keep his house up to date. So you think you're going to get money for your house, you get a lot less. And fully consider all the risks you face. And I think that was my... Yeah, this is just to say, can't keep me responsible for anything I said here. Thank you.
Right. Ladies and gentlemen, a round of applause once again to Riaan and Lynette for the wonderful work that they've done. We do have a little bit of time for questions, and I want to ask Lynette and Riaan, Maybe you can just come and stand next to me here, and then we just take the questions as they come. We'll take questions maybe for a few minutes, depending how many they are, and then we'll step outside. I think there's something to nibble on before we all disappear to our
How much of the
respective
lack
corners.
of saving for retirement and other savings is based on poor financial management, and how much is genuinely actually don't have enough money to save?
Interesting one. Can you answer that one?
Well, I mean, I think, as I said earlier, I think there are a lot of people out there that simply do not have the means to save.
Yeah.
They just basically just get by. And that is a problem in South Africa. But I think, there is a wider problem. It's hard to say how big the problem is, but I think it's generally quite widespread. People that should be able to save a lot more, that simply do not, because, I still think that my personal view is that I'm sometimes surprised at the lack of financial sophistication of people that should be financially sophisticated when it comes to these things. Investment issues and providing for retirement and future liabilities. I still get the sense that people either, my gut feel is, and I'm really talking off the cuff here, that people do not go to the trouble to do some financial analysis or have somebody do the financial analysis for them. Figure out what will the child's education cost you one day. I mean, I remember years ago we had the educational policies in South Africa, and lots of people bought them, and when the kid was born, at the time the kid went to university, they discovered the policy couldn't even pay the first year's books, let alone the full education cost. And didn't have anything to do with the investment return on it. It was because people started paying 50 Rand a month, and 18 years later they were still paying 50 Rand a month. They should have increased it monthly, annually, at least with the inflation rate. That's the one thing. And secondly, education costs in South Africa exploded. I mean, I looked at it a long time ago, but education costs at that stage rose like 3 to 4 times faster than general inflation. So, if you had somebody looking at the situation for you, that person would have told you, hey, hang on, you can't do 50 Rand a month forever and expect it's going to pay your kids' education. So it comes to a bit of financial savvy, just speak to even the person here that said, I don't have money, so I don't have a financial advisor. That's exactly the person should have one. So, I think I've always said, like economics should be a school subject, and probably basic finance also. This kind of thing should be compulsory school subject.
There is another question we have in our survey, and I can give you the results after. We also added it in. If your friends asked you to go out, and Donna can help me, to go out and you couldn't afford it, what would you do? Okay, we haven't put it in the presentation. And I can give you the results. So the proportion of people say, I'm going to go anyway. Just going to go. I'm not going to stay at home. And unfortunately, Cape Town people are more likely to go anyway. Yeah. There's another kind of just, well, you know what, I can't afford it, but I'm just going to go. Kind of an attitude to money and finance. If you're interested in, I can give you the percentage.
Thank you. So the last question, Riaan, you mentioned in passing, which I find interesting, that you're very optimistic about public service delivery improving around education service delivery. I'm just interested to know why.
Well, at this stage you could probably say it's more hope than anything else, but I think, I always argue you don't get any progress unless you have some form of a crisis. The Eurozone had to collapse into full-blown crisis before they did something about it. And you can basically go all over the world. So I think in South Africa, at the moment, what I sense is there's a sufficient sense of crisis in the head of government that we need to fix this thing. We simply cannot allow service delivery to continue to go backwards. It's pointless to go from a position in 1994 where a relatively small portion of the population, or put it the other way around, a relatively large portion of the population didn't have access to piped water and to electricity. And now you put it in. But now the service delivery is so bad that, yes, the infrastructure's there, but it's always off. At the local level, it doesn't work. So I think that sense of crisis, you need to fix these things. And remember, in South Africa, we don't really have, I think, a major crisis at the moment. I mean, crises like Greece, we had a couple of years ago. South Africa, mid-1980s. I mean, I was at university, drove through the burning tires. That was a sense of crisis. That was no fun. So that's a crisis. Crises develop only in 3 places. They develop in the streets, Greece, South Africa, wherever. They develop in the financial markets, the currency collapses. Something goes wrong, what happens? Your currency collapses. That's a sense of crisis. The third one, it happens in the head of the policymaker. The policymaker says, we need to change. And I think that sense of, not full-blown crisis, but that sense of urgency is certainly starting to develop quite rapidly within government. And that's why I think once you have the sense of crisis, I think that's when you get action. So, that's what gives me hope. Just all those things that government are saying and so on. So I think the trouble with these kind of things is it's not bad today and good tomorrow. It changes gradually. Just like it didn't go from good to bad overnight. Things change gradually. So I think it's not something that you will open your eyes tomorrow and say, hey, things are suddenly wonderful. It'll be a gradual thing. And I think the fact that, lots of people are saying that Pravin Gordhan got demoted, I think it's a good demotion then. Because I think he's a strong person, and putting him in charge at the local level in particular, I think might be a very good thing. So from that perspective, I'm pretty happy with him having moved from finance to local government.
Your slide number 11 seems to indicate that the debt, our commitments to debt, or rather the findings on repayments to debt, are averaging 15%. Mm-hmm. We've got slides that we use on financial education that talk to debt to income ratio being anything between 75 and 85%. John Manyike will attest to that. Mm-hmm. Could it be there is a dissonance in that respect, and there is potential to save? Because when we look at consumption, the percentages are quite high, and I just wanted to understand the vast difference in that.
In the debt to income, can you answer?
Debt to income ratio and our ratings.
Okay, can I answer that? You've got to distinguish between a stock and a flow. The debt to GDP ratio is a stock. That is, if you take everybody in the country's total debt, all the money that they owe to a bank or wherever, you take it all together and you express that as percent of people's income. Remember, the stock of debt is relative to the income. So it's two things you shouldn't really compare, but it's used everywhere. You've got to compare flow with flow. So that stock of debt, 75% of annual income, which just comes to a number, to service that debt in terms of interest payments and capital repayments, that's what generates the flow. That's the 15% that you talked about. So you have 100 Rand of debt, and it costs you 10 Rand per annum in terms of interest payments plus the capital repayment. Your income is, say, 200. Your stock of debt, which is 100 over your 200 income, would be 50%, but your cost to service it will be 10 over 200, which is 5%. So that is, it's just comparing stock with the flow, and the flow with the correct one is the flow with the flow. It's a 15%.
Right. On that note, ladies and gentlemen, thank you very much for joining us, and thanks to Lynette and Rian Leroux. Okay.